Please switch off your volumes. Uh, we start today's market talk. Extreme volatility could derail your long term return potential if your portfolio is skewed towards illiquid market cap categories. We saw this now last week and a week before that also. All those stocks where the float is less and they just corrected 10, 15, 20%, and then some of them have bounced back, but that is the risk. And at these levels where the market is near peak, uh, so everybody is thinking, should we book profits or should we hold? It is advisable to have core allocation to larger market cap categories because there is liquidity there. Hence, there is not too much of a drop in case there is some negative sentiment. Small caps have higher volatility, and it is a time to recalibrate your portfolios. Market setup as I see it, so that there are only two major triggers right now. One would be rate cuts. So central bankers are likely to avoid the mistake of loosening too soon, and so are far more likely to do so too late. Because even in case if you see in the US, the consumer spendings are robust, and which is driving faster than expected, and US economy defied all the grim forecast of a recession, and the GDP grew 3.3% after 4.9% gain in previous quarter. So if there is no problem and there is no recession or there is no lack of growth, the central bankers will all wait for the growth to falter before cutting rates. So that is one opinion. Uh, the other big trigger which is going to be would be the budget, because that will determine the direction of government spending. So budget may either go in for more handouts this year and increase spending in rural areas, or government may continue its capex push. It can go either way. So, because the central government has promised to prune fiscal deficit down to 4.5% of GDP by FY 25-26 from 5.9% in current fiscal, farm sector growth is estimated to be 1.8% year on year. Rural wages in November grew only 0.2%. So there is some kind of a distress in that part. So budget may go in for more handouts or increase spending in rural areas. Now, in case the government continues with the capex, then they require funding, because they can't just keep borrowing, because the total fiscal deficit of states and central government is around 9% now. So for funding, government can go for divestment, privatization, or asset monetization, which they have not been able to do in the last fiscal year. Capex push, incentives for affordable housing, other programs are good because they provide jobs, and but also other issues like PLI etc. are good because they help in capital expenditure by corporate sector, which is needed for job growth, because presently it is only government capex which is driving the economy. And there is a big opportunity in capex for transition to green economy also. So we'll have to see where the focus is. One area where there is a focus is on defense modernization. Expect the government to continue its focus on capital expenditure and indigenization. So capital outlays on defense services increased by 11% per annum from FY19 to FY24. So just keep that in mind. It has increased by 11% only, though it was paltry earlier also. Before that, it was around 3-4%. So defense procurement from local vendors has led to higher order inflows for all the defense PSUs, especially all the uh, all the shipbuilders, BL, HAL, etc. Now coming to some stocks which are in focus, Paytm has improved its performance, but the loan distribution business may continue to face pressure. This quarter, the Paytm's net loss narrowed to 222 CR. Posted operating profits. Revenue from operations was up 38% year on year and 13% Q on Q due to strong loan disbursements, increase in gross merchandise value, and merchant subscription revenues. GMV stood at 51 lakh crore in Q3, and has grown 46% in past year. GMV is total payment, that is gross merchandise value is the total payments made to merchants through various instruments platforms of Paytm. And Paytm gets, I think, around 0.5 to 0.9% margin on that. It has over 1 crore merchants who take subscription for devices and contribute to subscription revenue. Lending reduced in Q3 from Q2 to around 15,000 crore from around 16,000 crore it was there in Q2. And company has been reducing loans below rupees 50,000 crore, 50,000, and focusing on higher ticket size personal and merchant loans. Losses are due to higher indirect costs, marketing expenses, employee cost, investment in data centers and cloud infra, also due to ESOP cost, which will remain high for 3 4 years. So it is unlikely that it will become profitable that quickly, because ESOPs are going to remain and cut down on their profits. Financial services are providing around 21% of their operating revenues. Business model is to offer payment solutions to customers and merchants right now for Paytm, and then based on this customer acquisition, cross sell high margin financial services to them. Lending in business is important for profitability, but there is a problem is competition now, because lending is the easiest business, and now Geo Financial Services is also going to come into this, provide competition. For Paytm, valuation has moderated now to 5 times revenue from 13 times it came at around IPO time. What is the risk? Risk is stake sale by foreign investors, and the trigger is MSCI index inclusion, which would support the stock price. The other stock which came out with little bit poor numbers was Laurus Labs. Top line growth was flattish, and an improvement in the formulation business and bio division was offset by lumpiness in CDMO and API sales. They had 23% decline in sales year on year and 89% decline in profits. Formulation business was helped by pickup in ARV, that is entry retroviral volumes. New facilities are coming up, but they are taking longer gestation period. So they are doing a lot of capex, but demand is not there. EPS is expected to be rupees 8 in FY25, and the stock is at around 400. So you can understand, if there is no growth, actually the sales are declining. Why should somebody pay such a high price for this stock? Stock is too expensive. Company has invested in advanced enzyme technology, cell and gene therapies, R&D expenses, etc., which have inched up. So it is basically a favorite due to potential, but not because of performance. And every quarter it tends to disappoint. Infrastructure push and strong real estate demand is aiding the cable and wire business of Polycab, but the concern is over corporate governance, over tax evasion. Core business of wires and cables achieved 18% year-on-year revenue growth, driven by volume expansion due to government infra projects. International business saw decline due to Red Sea issue. FMEG, fast moving electrical goods, had a poor quarter. Fans and lighting business was sluggish. EBITDA margin and profit after tax margins declined. So be careful, just don't have to buy it at any price. Look for dips before getting into Polycab. Bajaj Auto had a good quarter. Premium products are helping. Valuation is expensive. Domestic motorcycles had 44% year-on-year growth. EBITDA margins improved from 18.5 to 19.5% year-on-year. Domestic over 125cc segments and three-wheeler segment is leading to higher demand. Triumph Speed 400, Scrambler 400X will be available this year. Refreshed versions of Dominar 400 has been launched. E two-wheeler Chetak continues to do well. Now they are likely to do around 250 rupees EPS for FY25. So it is roughly at 30p. It is still cheaper than TVS Motors. Hence, on all dips, this stock can be accumulated, and they give, I think, 2 3% or 3 4% dividend also. So if that dividend is also there, then it's like that dividend is half the GSEC yield without any risk. US 10-year yield daily chart. So if you see here, the yields are rising now, and now it is crossing the 50 EMA, and the 20 EMA is also heading higher. So this is because the expectations of rate cut are receding from March to maybe May, June, or uh, later date, and number of rate cuts in the calendar year 24. So that probability is also reducing. Brent crude, see the chart. It is at generally the same level, though it had a positive week. It's reached at 83 odd levels, but it is still in a declining trend line, and the base is around 70 is the level where the buying comes in. So it is right now consolidating, and let's see where it goes. Right now, the Red Sea issue and other problems of supply chain haven't had much of impact on Brent crude. US dollar index, again because of lower rate cut expectations and the strength of US economy, it is rising up. So it had a positive week and is reaching that 103 odd levels, and it had a low of around 90, and then it has been to 114. So let's see how it goes from here. Gold, I had been telling that around 20-70 dollars to an ounce, the selling comes in and it corrects from there. Now it has corrected last week to its 20 EMA. So if the dollar strengthens, the gold and other commodities always weaken. So right now there is not much of uncertainty in the international environment, and gold is a play on uncertainty. So right now, if the economies are doing well and the stock markets are doing well, there is lack of interest in gold. Nasdaq 100, it had a good week. It made an all-time high. It has broken above the previous high. So it's in a bull market with all these big seven stocks, especially Microsoft, Google, Alphabet, Meta, Nvidia, etc., doing very well. India's 10-year yield is in a declining trend line post that hike which was done in 2022. After that, it's on a declining trend line, and once the this timelines for inclusion of Indian bonds into global bond indices are clear, then it is expected to fall down further. Plus, once there is a more clarity on rate cuts by RBI. Nifty, if you see, this is the weekly chart. So on the weekly chart, Nifty made a second lower low candle after that big red candle it made in the previous week, which indicates basically weakness. Uh, but the other point is that if you see the last three lows, they have been higher. So Nifty is in an uptrend. So the trend has not changed, and it is making higher highs and higher lows. So that way it remains positive, and it is trading well above the moving averages. And generally, it takes support at 100 or 50 EMA. So even if it corrects, it may correct up to these levels, and then may resume its rally upwards. This is the daily chart. So if you see here, it's unable to cross the midpoint of the long body candle of Tuesday. So this week we had just three trading sessions. We made a long red candle on Tuesday, went up a bit, and then corrected on Thursday. So we are unable to cross the midpoint of the long body candle of Tuesday, which shows some weakness now. And so we are in a corrective phase, and which started from the high which we made around 15th of Jan, where we made this high of 22,000 plus. So after that, we are in a corrective phase, and the corrective phase generally lasts for around 3 to 4 weeks. So after that, if you see here, we are making lower highs and lower lows. So this is a cause of worry. Nifty is struggling and broader market is showing a bearish setup basically because of weakness in Nifty only. This is Reliance. It had a dip on Tuesday, took support at 20 EMA, but then it has bounced back from there and it had subsequent rise. Bajaj Auto, again daily chart. It came out with results and with high volumes it has gone up. So this is looking positive. Nifty Bank weekly chart. If you see here, it had two big red candles in the last 2 weeks, and now it is closed below the 20 EMA on weekly charts, and it's heading towards 50 EMA. Generally, it takes support at around 50 EMA, which is at around 44,160. So this will be the first level to watch out for on Nifty Bank. Most of the constituents here are weak. This is a daily chart. On daily chart, it took support at 200 EMA, which is at around 44,567 right now, and then bounce from there. So this is the major support zone. If it bounces from there, it's okay. Otherwise, it will go into a bear market. Basically, the bigger constituents of Nifty Bank are weak, and it's basically because of that. Initially, it was the correction came because of HDFC Bank, but then other banks have also followed suit, taking the Nifty Bank down. Now, if you see this chart, you see here, this was the low of October of Nifty Bank around 4285, 42,085, and the high it made around 48,634. From that, it has retraced to 62% of the up move, and we may make a new low for the year next month. Results of most banks, as I brought out, and other than ICICI Bank, no other bank has the capability to lead the revival. So use these rallies, whichever rally takes place in any indices or basically indices to short. Investors should get into cash and buy after 1 or 2 weeks after there has been some correction into various stocks and indices. HDFC Bank continues to be weak and has tested the 200 EMA on weekly charts also and went below that, and it has closed below that also on high volumes. The RSI is on weekly chart is yet to reach that oversold levels, so it may correct a bit more also. Uh, it has to, in case it doesn't take support here, it may go to test the 1350, 1300 odd levels also. ICICI Bank, though it came out with decent results, so right now if you see the RSI, it is still at 60 odd levels on weekly chart, so which is bullish. So it tested that high of 1050 odd levels, but then it corrected and then closed lower. And then there was a lot of buying at 998, 997 levels during the week, last week for ICICI Bank. PSU Bank rally has been halted, though it is above the trend line, but it had a red candle and it went below that, but then it bounced back. So right now it is bullish until the time it is trading above the red line, and the results are decent, but I think there is a wait and watch for SBI results. SBI has had on a weekly chart has corrected from the top it made around 650 660 levels and has come down to 20 EMA and may correct from here to 50 EMA and then may bounce back from there. RSI is around 54, so there is not much of momentum here with this stock. Bank of Maharashtra is one stock where there is momentum. It is RSI 67, it is trading up. It took support at 50 EMA on the daily charts and then bounced back from there on good results. Right now, this stock is expensive, so if you have to buy this stock, look to buy at around the 20/50 EMA. PSE index continues to show strength, though it had a red candle, but still it made higher highs and higher lows during the week. So this is right now consolidating. Hopefully, some strength or momentum will come. Right now, it is has been on an upward trend uh, from 2023 onwards, March April onwards, and it has constantly gone up. NTPC is a stock which is showing strength, and on daily chart to see it is above the 20 EMA, and this 20 EMA level of 307 to is a good level to buy, though it went around to 300 odd levels during the week, but it has quickly bounced back from there. RSI is in a mid zone, so there is not much of momentum. So it probably it will dip below a bit more to gain some momentum. This is one stock which is in good momentum. RVNL, the part of one of the railway PSUs. So if you see the RSI is at 77, it's overbought. It is trading well above the moving averages, and it had a daily chart. It had a big red candle, came down from around 340 levels to around 280 to 90 levels, and then it has bounced back a bit. But this is volatile now, and profit booking is taking place because this is at elevated levels now. Uh, the other stock, which again is very elevated, is IRFC. This is a weekly chart. It had a solid week where it went from around 110 odd levels to 170 plus. So it went up to 180 but corrected from there last week. Had a big dip but recovered. So let's see what happens. The volumes have been higher over the last 3-4 weeks on this stock. Nifty IT index, from the highs it had made and the lows it has made subsequently, it has retraced roughly 78% of the fall, but it is now lacking momentum. It has had two red weeks because the major constituents uh, are not showing any strength. That is TCS and Infosys. Results were not that good. Enthusiasm is not there. It's only the second rung stock like Persistent, Birlasoft, etc., which are showing strength, but they can't drive the index to new levels. Infosys now again here it has broken through that declining trend line. So this is last week was a green week, so it was a positive week, but again it is losing momentum. So let's see from where it goes. But right now it's in a bull market and trading well above the all the moving averages, and RSI is around 70, so it has some momentum right now. The other stock which is showing momentum in IT sector, as I've spoken about it, is Persistent. Came out with good results. It had a gap up opening last week, and it has gone to around 8,300 odd levels. But right now it is expensive, and then on Thursday it corrected from there. So let's see. Though RSI is overbought now, around 80 right now, so it's overbought. Midcap index on the Nifty, this is a weekly chart. It had a red candle and it corrected from the top. So because this the stocks here are looking expensive now, and I think it needs to correct a bit for gaining some momentum from here. So be careful with the stocks which have run up a lot. The small cap index had two negative weeks and it made a lower low now this week and a lower high. So here the profit booking is taking place. So right now this is the time to move to more safer names than the less liquid names. Hind Copper, one of the stocks, it is showing a inverted head and shoulder pattern, and so it is looking good to go up to 300 and 320 levels from here. This is basically based on the news of Chinese stimulus to their equity markets, and overall moment there is a stimulus from the China, then the metal generally do well. So all metal stocks were positive. This is one of the safest stock. So if you see from the declining trend line, Varun Beverages has gone above that thing. So it is showing some kind of momentum. It has taken support at its 20 EMA. So watch out for this stock. This is a good stock to accumulate on all dips from here. I'll cover three stocks today. The first one is GravitaIndia. GravitaIndia, established in 1992, is one of the largest lead recyclers in India, with a market share of 18 to 19% in the organized lead recycling market. Company's business is organized across four specialized verticals: lead recycling, which is the main business flagship, aluminium recycling, plastic recycling, and turnkey projects. Company also has expertise in the recycling of used batteries, cable scrap, other lead scrap, aluminium scrap, and plastic scrap, among others. It is expected to be beneficiary of the government's latest regulation on battery waste management, as the same would result in strong double-digit volume growth for its India lead sales volume. Moreover, the company is implementing sizable capacity expansion plans for existing recycling verticals in India as well as in the overseas market. Focus to diversify into new recycling verticals like rubber, copper, paper, e-waste, and lithium because of the introduction of lithium-ion batteries now for electric vehicles. So these are the new business avenues and would support the achievement of management's target of 2027 of 25% and 35% respectively growth in revenue and profit after tax, along with 25% ROCE. Volume impact was there this quarter of 100 to 120 crores because of logistic issues in Red Sea. It is likely to normalize by mid-year 2024, and thus expect volume oblique margin to also normalize going forward. Management is in discussions with MCX for hedging options for aluminum. I'll cover this issue later. If you see here, uh, the sales volumes declined by around 4% year on year and around 9.4% Q on Q, while the profit after tax was higher by 20% year on year and 4% Q on Q. This was because the operating margins were higher. They have risen 285 basis point year on year and 228 basis point year on year. This is because of higher realization on lead recycling business. Uh, so the stock has halted its path because they didn't see that growth in the earnings and all that and revenues. EPS, if you see this quarter's EPS was around 8.7, and it has improved over the last few quarters. Uh, this is the volume breakup. So if you see, the major part of the business is lead only, and aluminium and plastic are around 8 to 10% part of the business only. So the lead business had a volume growth of around 1.8% year on year and a negative growth of around 11% Q on Q. But aluminum and plastic had major reduction in volumes year on year and Q on Q. Margins of lead business were higher, which led to higher overall margins, while aluminum margins had dipped, and the the plastic margins were flat Q on Q. So if you see the valuation, it is expected to do around 4,000 odd crores of business in FY25. So, and it's expected to do a EPS of around 40-42 in FY25. So with this valuation, uh, it can easily trade at uh, at a much higher valuation at 40 into 30 times, that is around 1200 rupees. It can easily trade at once the momentum comes because of better revenues in this stock. Q3 PAT, if you see, we have seen was higher due to higher margins but lower volume because of Red Sea issue. Lead margins were up 37% year on year and 32% Q on Q. Aluminium margins declined 22% Q on Q. Inventory levels increased. They are looking for inorganic opportunities in recycling. They are doing capex for existing recycling verticals of 400 crore and 200 crore capex for new recycling verticals. So these are the key project updates for their Tanzania business. They have started commercial production of plastic at existing recycling plant. Capacity is around 1800 metric ton. They are doing some capex. Togo, commercial production of lead from existing recycling plant. Capacity is 6000 metric ton per annum. They're doing capex there. Chittoor increased capacity of lead recycling to 640 metric ton per annum. Capex they are doing there of 21 crore. Tanzania, rubber recycling has started. Capacity 3000 metric ton per annum. Capex is around 4 crore from internal accruals. Mundra, they are increasing capacity of lead recycling to 60,000 metric ton per annum, and they have started value added production of red lead with a capacity of 4,800 metric ton per annum and started plastic recycling with a capacity of 7,500 metric ton per annum. Oman, they signed an MOU to establish battery recycling plant through JV. Capacity is 6,000 metric ton per annum in phase 1. So this is their first recycling facility in Middle East. So if you see, their capacity is improving to around 4,25,000 metric ton per annum by FY26, which is nearly 40% higher than what it was there uh, in FY23. And capex they are doing both on existing verticals and new verticals of around 600 plus crores. See their chart on Thursday, it had gone down to its 200 EMA, tested that at around 840 odd, and then it bounced from there. So some buying had come. You can see there are higher volumes here, and it had corrected. So this is in a weakness. This is a level at which you can accumulate this stock. Uh, the stock has got good long-term visibility, and it's a play on regulatory tailwinds and battery waste management regulations by the government. The other stock which I'm looking today is Cyient DLM. They reported a strong quarter with revenue growth of 50% year on year in third quarter, led by a significant traction from aerospace and defense verticals. Defense segment grew more than 100% year on year, while aerospace grew 75% year on year. Order book stood at 2290 crore. Now, just compare subsequently with their annual revenues as on third quarter FY24 to report a CAGR of 41%, 44%, and 81% in revenue, EBITDA, and adjusted PAT over FY23 to 26. Exports for third quarter stood at 170 CR, which is 54% of total sales versus 182 crore in third quarter FY23, which was 85% of total sales. So that means their business is now growing in India also. So they are not dependent on export market only. So less likely to get disrupted. Company has inaugurated new precision machining facility in Bangalore with 36,000 square feet of manufacturing area. Now, if you see their result, they had highest revenue. This is in millions, so 321 CR of revenue in the last quarter, which was up by around 49% year on year. And the profit before tax, profit after tax was again highest, and year on year change is around 222%, Margins are also higher, both for profits and EBITDA. EBITDA has though come down this quarter, but it is expected to go above 10% in subsequent quarters. So it is expected to do around 1210 crores of revenue this quarter, and I showed you the order book is around 2400 crores. So they have a visibility of orders for at least 2 years, and so the margins and all other parameters are likely to improve. So if you see there for the future, 1200 crore CR, 1200 crore they will do this coming present year revenue. FY25 they are expected to do around 1700 crore, growth of around 40%, and FY26 around 2300 crore. And EBITDA margins are expected to remain stable at around double digit 10 to 11%, which is good. These expenses are likely to remain under control. They are not going up. Uh, PAT is also expected to improve, and with margins also, PAT margins also improving now, reaching 7 to 8%, which is helping in their profits. This is their product-wise revenue mix. So basically, it 67% is PCBA, 27% is box build, and cables and others are 3% each. End user industry-wise revenue mix. So if you see, majority is defense and aerospace, with little components from industrial, medical technology, and others. This is a chart. So if you see, it had IPO and listed in July last year. It went up, and then after that it has been correcting now. So it may again bounce back from here uh, post these results. So this is a good level to accumulate this stock. Though the margins declined this quarter, uh, but higher revenues provided good profits due to higher SG and A expenses, that is selling, general and admin expenses. They hire a lot of CXOs now. So overall, for future, expect 10% plus margins. And for EMS businesses, that means they are adding value to the products they are making. Highest ever quarterly revenues I showed you. Net working capital days has risen to 118 days. They plan to bring it to 100 days. Capacity utilization is still low, so they have excess capacity. It has reached around 50%. Expansion plan towards cable and box build businesses are there. It is expected to do around a EPS of 14 to 15 rupees in FY25. So, and 23 to 24 rupees in FY26. So on every dip, this is a good business to hold for long term. Uh, if you get it closer to its uh, moving averages at around 850 or 650 levels. This is a good accumulation range for this stock. The last stock is Union Bank of India. Strong Q3 profitability with 1.07% return on assets was backed by stable operating performance and modest provisions. Key positives were sharp GNPA improvement, down 155 basis points Q-on-Q, healthy 7% Q-on-Q loan growth, sustained 1% ROA, and strong liquidity and capitalization. With healthy credit growth persisting and modest credit costs, earnings are expected to be robust. The loan book was 8.6 lakh crore, up 14% year-on-year, driven by secular growth across segments, cleaner balance sheet, adequate capital, and a strong deposit base. So you can expect the credit growth to be faster. Higher business growth combined with stable margins and favorable credit costs could lead to strong profitability in the medium term. Estimate of 1% ROA through FY24-26. Now, if you see here, the interest incomes have been going up, and this is the highest for in this quarter, around 254 billion. That is 25,400 crores. Net interest income is going up. It is constantly having year-on-year growth, and this quarter was 6% only. Total income again was slightly lower. Operating expenses are under control and declining actually. Profit before tax is going up. Profit after tax is improving. Year-on-year growth is around 60% for profit after tax. Now here if you see the key financials, the net interest income is expected to reach around 365 billion, that is 36,500 odd crore this year, and is expected to keep moving up. EPS is expected to be around 23-24 rupees in FY25. So this is trading at around a PE of around 6 for FY25, and we had covered Yes Bank, which is has a expected EPS of around 40 paisa, and it's trading at much higher valuation. So you can compare it accordingly as to, and it is stable. It is showing stable growth, stable asset quality, where GNPAs are declining. Uh, Price to book is around 1 for FY25, which is good. ROE, ROA are improving. Cost to income is declining, and names are improving to around 3% plus now. So here if you see the net interest income growth is improving now, which is the real earnings of a bank, and rest of the things are under control. And so the profit, PAT, all are improving. EPS is on the upward trajectory, and it is a dividend paying stock, so it pays around 4-5 rupees dividend, which comes out to good dividend yield. And here in the, if you see the ratios, NIMs are improving. Cost to income is declining. Dividend is likely to be up. Credit to deposit ratio is improving, and still it's under control. NPAs are declining. Net NPAs are also declining. Provision coverage is good and improving. So that means they are well covered. Book value is improved now. So it is expected to be around 140, and that is the present price also for FY25. ROE, ROA are improving. So if you see here, cost to income is under control, 43.8, and it has not gone up substantially. NIMs are improving and 3% plus now, and cost of deposit has gone up because of higher interest rates now, and there is so much of fight to get among banks to get more and more deposits. The GNPA and NNPA are net NPAs are declining. ROA is improved and now is clearly above 1%. This is a chart. So if you see here, uh, they did a QIP at around 86.55 per share, raised 5,000 crore in August September. So this is the level we got this stock around this price of QIP, and after that it has given good returns, and there is a rising trend line, and it was stopping because of that, but it has traded above the 50 EMA after that, and even if it doesn't crosses the rising trend line, it trades along with this also. It will give you decent returns over a period of time, decent and safe returns over a period of time, because the NPAs are declining, and due to higher recoveries and write-offs, and the management is decent now. Slippage run rate is below 1.5%, and that is around right now it is 1.3% of loans. So if they are able to raise capital because of the good ratios and good management of the assets, so it should continue to do well. I have finished. We'll take questions now.